Hello, fellow rebel capitalists. Hope you're well. We're back to the normal videos after that awesome live stream from my good buddy Chris Martinson. If you haven't checked that out, definitely do so later on this evening. But right now, I want to talk about inflation. CPI print out today. Riz goes from 6.8% up to 7%. Let's dive right into the story with CNBC. Inflation rises to 7% over the last year. So this is the trailing 12 months. Highest since 1982. Key points. Consumer Price Index, inflation gauge that measures costs across dozens of items, rose 7% in December from a year earlier, the fastest pace since 1982. That was in line, however, with economist estimates for the first time in a long time. And stock market futures rose after the release, excluding food and energy, so-called core CPI, which is what the Fed likes to look at, was up 5.5% on the year, the biggest growth since February of 1991. Inflation plowed ahead of its fastest 12-month pace in nearly 40 years during December, according to closely watched gauge the Labor Department released Wednesday. And they're talking about, let's see, on a monthly basis, CPI rose 0.5%. The economists surveyed, their expectations was for looks like a raise of point. No, let me read this to make sure I'm getting it right. Economists surveyed by Dow Jones had been expecting the gauge to increase 7% on an annual basis and 0.4% from November. The annual move was the fastest increase since June of 1982. Here's a chart. I want to look at this chart. Most of you will be familiar with it. But let's look at this chart, understanding the Fed is trying to taper the quantitative easing down to zero. They're also saying that they're going to raise rates at least 3 times in 2022. And according to the Fed minutes, we got a week or a week and a half ago where the market was caught way offsides and just fell out of bed. They're also considering doing quantitative tightening. So not just tapering the QE program, but actually doing the opposite of quantitative easing, where they're selling assets into the market, reducing the amount of bank reserves denominated in dollars that are on the balance sheet of these commercial banks. Technically, that should decrease their balance sheet capacity to create more loans moving forward in areas or in markets like repo. I just did a video on that, a whiteboard, should be out tomorrow night. Did a video on that yesterday. But let's think through how the Fed can pull this off if the stock market goes down as a result of the interest rates rising, the taper, or most likely because of quantitative tightening, if we get to that point in the first place. Most of the pushback you get from your friend and family member, Fred, the average retail investor, is, oh, George, you're just fear mongering. No problem. The Fed will just step in and just drop interest rates again, and they'll just do more quantitative easing. Or the government will come in and they'll do a CARES Act 2.0. And instead of $5 trillion, maybe this time they'll spend $10 trillion. We just don't have to worry about the stock market going down ever again. Because even if there is a black swan event, a small blip, the central planners will come in and just prop up the market. We've got nothing to worry about. So always, always buy the dip. So what your friend and family member Freds are not considering is the fact that now we're living in an environment that is extremely unique considering the last 40 years, and very unique when you consider how long the Fed has been intervening to the degree to which they're intervening today. So going back to the 1960s, the 1950s, the 1970s, or even from a standpoint of probably even into the 1990s, the Fed wasn't coming in and heavily manipulating. Well, I shouldn't say that, because they're definitely manipulating rates. We haven't had a market interest rate for a long, long time at the short end of the curve. But the long end of the curve really wasn't being micromanaged by the Fed, or they weren't trying to micromanage it. And they definitely weren't doing quantitative easing like we know today. So this is something that's we've seen over the last decade. And the market participants, I think, have been conditioned to believe that there is a Fed put, there is a government put. And so they don't even consider what might happen if that put went away. Or they don't even consider what would prompt the Fed put to no longer exist, or the government put to no longer exist, or at least not be a viable option. Here's what I'm talking about. If you've got inflation or disinflation over a 30-year period or a 40-year period, let's say, that gives you a lot of cover to come in and print money. Let's just use that term very loosely. Just create additional dollars, or expand the Fed's balance sheet, however you want to define that. But regardless, it gives you cover to print money, quote unquote. But how do you do that in an environment where the CPI now is standing at 7%? Just think what would have happened if they would have tried to expand the balance sheet to the degree to which they're expanding the balance sheet now. Talk about the Fed, or expanding the amount of dollars that are circulating in the real economy to the tune of, let's say, 25%. Like we saw, if you look at M2 money supply going back to 2020, what would have happened if they would have done that in the 1970s? It would have made inflation far worse. It definitely would not have made it better. That's for sure. So that type of argument, just going back, we had a stock market crash from 72 to 74. Just think if someone would have come out, an economist or a political figure or a hedge fund manager or someone on, I don't know, probably didn't have financial media back then, but maybe they did. What if someone would have come out and said, I know what we need to do during this stock market crash of 1972 to 74. We just need to print more money. Everyone would have looked at them like they're absolutely out of their mind. Why? Because they associate money printing or additional dollars with exacerbating the current rate of consumer price inflation. So I think you see the same phenomenon now. So this is a completely, completely different environment than what we saw after the dot-com bust, or what we saw after the GFC, or March of 2020 with the cerveza sickness, because now their only tools that they would have to combat a stock market crash or an asset crash would be something that would exacerbate an inflationary problem that politically might be even more problematic than the stock market or the housing market going down in and of itself. So they're walking a political and a central planning tightrope that we all need to be cognizant of. So let's see how other things have, or let's see other assets responded to this new print of 7%. Let's start by looking at the US 10-year. This is a 5-day chart, and it was kind of trending down prior to this announcement. But starting, what is today, Josh? Is today the 12th? Or I guess it would be the 12th today, wouldn't it? So pretty much flat. I'm not sure when the announcement came out, but it went up to maybe peaked out at, I don't know where. I mean, we're kind of splitting hairs here, but it went up a little bit, went down, and pretty much ended the day flat, which is at 1.752. I think the bigger story here with the 10-year Treasury is how much the yield has actually gone up in the last, call it, month or so. I mean, the 16th of December, the yield was at 1.4%, now at 1.75%. That doesn't sound like a lot, but 35 basis points on a 10-year Treasury in a month, that is a big, big move. So pretty much flat on the day. I think it's because the CPI print was close to market expectations. So nothing really dramatic happening. Now let's check out what happened to gold. And here it looks like these are daily charts. Gold is up to 1825, up about $5 or 0.28%. Silver up 1.74%. That's interesting. But so a little bit of a change here, but we're seeing kind of a move to the upside with the precious metals. And I mean, this makes sense, but I don't know that the CPI print had a lot to do with this because, again, it was kind of in line with most market participants, what their expectations were. Now, I think gold and silver is a great investment right now because no one's paying attention to it. And it's kind of unloved. And I'm not saying I'm buying it right now, but I really like to put things on my watch list that everyone has left for dead, or everyone says that, oh, that's antiquated, that's a barbarous relic, and no one buys that anymore. That's ridiculous, George. When people start saying that, like they have said that over the past year about gold and silver, and the gold miners especially, that's when I really get interested. So again, I'm not buying now, but definitely on a watch list. And I think this bid that you see today, I don't know. That could be just noise. I don't think that really is a result of the CPI print. But now we get to something that's really interesting. So let's look at the US dollar. This is just a 5-day chart. And just 4 days ago or so, we were at 96, basically point 0.2. And 4 days later, now we're at 95. And that's another significant move down in the dollar over just, call it, 4 or 5 days. So this is something I would really pay attention to. When we see the yield on the 10-year really going up, we see the dollar going down, especially when it's in an environment where we have high degrees of market volatility, especially on the downside. Usually you would see a flight into the dollar, therefore rates going down, the dollar going up. But now we've had this market volatility as of the last couple weeks, especially since we've after Thanksgiving, when we heard about we'll call it the new scariant, to be YouTube friendly. So you would expect with the new scariant and everything that's in the news, and with the stock market going down, Fed raising interest rates, talking about quantitative tightening, stock market going down even further, that there'd be a bid for a dollar, there'd be bid for a treasury. But now what we're seeing is the dollar's not getting so much of a bid. This is not a prediction. I'm not saying that the dollar is going to go straight down from here. I'm saying that it's an observation, and it's something that we all definitely need to pay attention to. All right, guys, I hope you enjoy the rest of your day. Always stand up for freedom, liberty, free market capitalism, and we'll see you on the next video.